Hello. Today you will learn what arbitrage is and how to start. Enjoy watching. Arbitrage is the practice of buying and selling assets simultaneously in different markets or in derivative forms in order to take advantage of price discrepancies. The goal of arbitrage is to profit from the difference in price by buying low in one market and selling high in another. Arbitrage can be applied to a wide range of assets, including stocks, bonds, currencies, commodities, and financial derivatives. There are various types of arbitrage, including spatial arbitrage. This involves buying and selling the same asset in different markets or locations. For example, a trader might buy a stock at a lower price on a foreign exchange and sell it for a higher price on a domestic exchange. Temporal arbitrage. This involves buying and selling the same asset at different points in time. For example, a trader might buy a futures contract today and sell it at a higher price at a later date. Statistical arbitrage. This involves identifying and exploiting statistical relationships between different assets or securities. For example, a trader might buy a stock that has a high correlation with another stock and sell the latter for a higher price, hoping to profit from the difference. Arbitrage can be a complex and risky strategy, as it requires a high level of expertise, rapid decision-making, and access to multiple markets or sources of information. It can also be affected by market conditions, regulations, and other factors that may impact the prices of the assets being traded. Triangular arbitrage. This involves taking advantage of discrepancies among three different currencies by taking positions in all three. For example, if the exchange rate for converting currency A to currency B is different from the exchange rate for converting currency B to currency C, a trader could convert currency A to currency B to currency C, and then currency C back to currency A, potentially making a profit from the discrepancies in the exchange rates. There are several risks associated with arbitrage. Market risk. Prices in the markets being arbitraged may change before the trader is able to close the position, resulting in a loss. Execution risk. The trader may not be able to execute both trades in the arbitrage opportunity simultaneously, leading to a loss. Counterparty risk. If the trader is using a broker or exchange to execute the trades, there is a risk that the counterparty will default or go bankrupt, resulting in a loss. Transaction costs. There may be costs associated with buying and selling the assets being arbitraged, such as commission fees or spreads, which can reduce the profit from the arbitrage. Tax implications. The trader may be subject to tax on any profits made from arbitrage, which can reduce the overall return. Regulatory risk. Changes in regulations or policies in the markets being arbitraged could impact the ability to execute the trades or the profitability of the arbitrage. Competition. Other traders may also be attempting to take advantage of the same arbitrage opportunity, which could reduce the profit potential or make it more difficult to execute the trades. Here are some steps you could follow to start arbitrage. Identify the asset or market you want to arbitrage. This could be a currency pair, a commodity, a security, or any other asset that is traded on multiple markets. Research the markets. Look for discrepancies in the prices of the asset in different markets, as well as any other relevant information such as trading volumes, liquidity, and transaction costs. Determine the arbitrage opportunity. Calculate the potential profit from the price difference between the markets and consider any costs or risks that may impact the trade. Decide on a strategy. There are several different arbitrage strategies you can use, such as simple arbitrage, statistical arbitrage, or merger arbitrage. Choose the one that is most appropriate for the opportunity you have identified. Set up accounts. In order to execute the trades, you will need to open accounts with the exchanges or brokers where the asset is traded. Execute the trades. Buy the asset in the market where it is cheaper and sell it in the market where it is more expensive. Monitor the trade. Keep an eye on the markets to ensure that the price difference persists and that you are able to close the position and realize the profit. It is important to note that arbitrage can be a complex and risky activity, and it may not always be possible to find and take advantage of arbitrage opportunities. It is advisable to thoroughly research and understand the markets and assets you are trading and to carefully manage your risk. That's all for today. Thanks for watching. Subscribe.